My name is Mike DeVolio from Intuit, and you're attending the 2012 Tax Law Update presentation. And a quick bio of myself. Hopefully you can see that on the screen. I'm a senior tax analyst with Intuit, and I've been with Intuit and Lacerte since 1987. Some of the things I do around the company, I monitor legislative and regulatory activity, take that info from DC and circulate it to employees and customers to make sure everyone's up to date. I also help out by analyzing and testing the software, training employees and customers, and lastly, I serve as a government and a public relations representative. So for the agenda today, we're going to go through 2012 tax law changes. Then we have a section on some important Healthcare Act changes that impact 2013, just around the corner. Then we have a section covering tax reform. And lastly, we'll finish up with some Internal Revenue Service initiatives. Okay, the last tax law that passed was just over a year ago. It was 3% Withholding, Repeal, and Job Creation Act. And it provided for a revised work opportunity credit for employers, and still filed on the Form 5884. And the maximum credit was $5,600 for companies that hire veterans looking for work over 6 months. And that maximum jumped up to $9,600 for companies that hire disabled veterans. And the credit covered the work beginning after the enactment date last year. And the credit was also extended 1 year into 2012 for hiring veterans. For hiring other people, that credit has expired as of 12/31/2011, unless the government resurrects it. So for 2012, it's just the credit is only available if the company is hiring veterans. This act also repealed the 3% withholding requirement on government contractors. And lastly, it imposed stricter eligibility requirements for premium assistance credit for health insurance in 2014. I'm sure everybody's been listening to the fiscal cliff discussions coming out of DC. And as part of those, we have the extender legislation. There's been many tax measures that expired at the end of 2011 or that are scheduled to expire at the end of 2012 unless the government extends them. The first group impacts tax year 2012, and then the second group impacts tax year 2013, as well as the 2013 estimates and withholding tables. So we'll have to see how those talks shake out. According to the IRS, AMT patch, which covers 2 components, the exemption levels as well as the special credit ordering rules for personal credits. And that AMT patch could affect more than 60 million taxpayers, so it's pretty widespread. And currently the IRS is leaving their core systems as is. In other words, they're assuming that the AMT patch does get extended. And if there is no AMT patch, it's going to have serious repercussions for taxpayers, long delays, etc. So since it's very difficult for the IRS to implement that AMT patch, they're running under the assumption that it will get extended. But if it doesn't, then they have to revert to the old law, and that will take some time to implement. For the other extenders, and we're going to go through them more thoroughly, like the tuition and fees deduction, those are not as complex. So we'll see a scenario like we had in 2010 where Congress extended those provisions in mid-December, and unfortunately it delayed the opening of filing season by 4 weeks for about 9 million taxpayers. And they would expect a similar outcome this year. Okay, so we have a quick poll. Do you think the government will pass the extender legislation this year? Please answer yes and no, and we'll see how skeptical the audience is here. So just a quick question at the beginning. Okay, we'll turn over the results. Oh, it was pretty Pretty optimistic. We have 76% saying yes and 24% saying no. So I think it will be best for all if the legislation does get passed. So we'll just have to see how it shakes out as we wind down towards the end of the year here. Thank you for answering those, by the way. So I'm going to go through the provisions that expired either at the end of 2011 or will expire at 2012. The first, as we spoke about earlier, the AMT patch has two components. The first is increased exemptions. Those are scheduled to decrease to $45,000 for joint, qualified widow, $33,750 for single, and $22,500 for marriage filing separate. Those will decrease unless the government decides to keep the elevated levels in play for 2012. Also, non-refundable personal credits are allowed to offset AMT. That will go away unless it gets extended. Also going away, the deduction for educator expenses, tuition and fees deduction, itemized deduction for sales taxes,
my gosh,
tax-free distributions from IRAs for charitable purposes, the refundable portion of the adoption credit, and the deduction for mortgage insurance premiums. We actually have seen some early drafts and even final forms from the government, and they have those lines where those extender provisions where they would be reported. The government has shaded out and reserved the lines in case that legislation does get extended, and they need to react quickly to the extended provisions. Also, continuing on, the credit for energy efficient improvements, 100% exclusion for gain on small business stock, contributions of capital gain property for conservation purposes, qualified zone academy bonds, deadline to claim low-income housing credits in a GO zone area, and tax incentives for District of Columbia. And as you probably read about, the government's trying to decide whether to let some of those provisions lapse for upper-income taxpayers only. So we'll have to see how those negotiations shake out, and see if we don't go off the fiscal cliff. Okay, next is a grouping of business provisions that expired on 12/31/2011. The important one there is the research credit, highly popular. Also, the employer wage credit for activated reservists, the Indian employment tax credit, and the new markets tax credit. The rest of the items here are lower impact, so I'm not going to read off the list. You can read them here on the screen or review or revert to your materials afterwards. And then on the next screen, we have some lower impact items as well on the business side. And again, these are the ones that expired at the end of 2011, and we don't know yet whether they'll be extended into 2012. Okay, also with some implications this year, depreciation. The bonus depreciation percentage has been reduced. It was 100% last year, and now it's going down to 50%, unless the government decides to tweak it a little bit. And that would be for assets placed in service after 12/31/2011 and before January 1st, 2013. Also, diminished benefits under Section 179. The limit is set at $139,000 with a $560,000 phase-out threshold for assets placed in service after 12/31/2011. That's quite a big reduction from last year, where we had a $500,000 limit and a $2 million phase-out threshold. Last year, the government extended into 2012 only off-the-shelf software qualifies as Section 179, and also the election to accelerate AMT credit in lieu of bonus depreciation, also extended only through 2012. Now, the next grouping applies to provisions that will are scheduled to expire on 12/31/2012. We have the Bush-era tax cuts. Currently, the tax rates are at 10, 15, 25, 28, 33, and 35%. On January 1st, they're scheduled to increase to 15, 28, 31, 36, and 39.6%. Also, the marriage penalty comes back unless the government decides to extend the more beneficial provision. The marriage penalty encompasses the size of the 15% bracket and the standard deduction for joint filers as well as qualified widows. The percentage, these two measures will decrease to 160% of the single taxpayer. Currently, it's at 200%. Capital gains and qualified dividend rates. Long-term capital gains and dividends taxed at a maximum rate of 15% right now. As of the first of next year, long-term capital gains scheduled to increase to 20%, with dividends treated as ordinary income. The 2% payroll tax holiday goes away. For estate, gift, and generation skipping taxes, the rates and the exemption levels will be less beneficial as of January 1st. Continuing on, itemized deductions and personal exemptions not phased out for higher income taxpayers. That will go away, and we'll have phase-outs returning on January 1st. Benefits will decrease for the following provisions: the child tax credit, earned income credit, dependent care credit, American Opportunity Tax Credit, the adoption credit, student loan interest deduction, Coverdell education savings accounts, and the exclusion for employer-provided educational assistance. So that wraps up the section there on the fiscal cliff. Now we're moving into some other items. One half of 2010 Roth conversion or rollover, and rollovers to designated Roth accounts included in income in 2012. That's if the taxpayer didn't elect to include 100% in 2010. And they should have reported half in 2011, and then the second half would be in 2012. So that's kind of a reminder out there for you. Schedule D and 8949. The 8949 for reporting of capital gains and losses was introduced last year into the individual module 1040, and the IRS is expanding that coverage this year. So for tax year 2012, 8949 will coexist with the Schedule D for not only the 1040 module, but also 1120, 1120S, 1065, and 1065B. For the 8865 foreign partnerships, they'll also use the Schedule D and the 8949 that is included on the 1065 partnership module. So the only exception then is 1041 for fiduciaries will not be modified to include the 8949. They'll only use the Schedule D. Not sure why the government decided to stop short of the fiduciary, but that's what we have this year. They're the only exception. Okay, now moving on to the 1099-K, which is the payment card and third-party network transaction form. There's, as we had last year, there's no direct reporting of amounts from the 1099-K directly to the tax return. And that includes the 1120, 1120S, 1065, and within individual Schedule C, CEZ, E, and F. So those lines were completely eliminated. Last year we had the lines on those forms, but we were told not to use them. This year the IRS decided to completely eliminate them, so we're reverting to tax year 2010 reporting. However, the 1099-K is still filed with the IRS, and they do some matching on that front. It's just not a direct correlation, which they expected last year, but they backed off of it. The informational reporting of employer-sponsored group health plan coverage. The reporting of the cost of the health coverage on the W-2 is optional in 3 cases. The first of which is the employer is required to file fewer than 250 W-2s for the preceding calendar year. And then number 2, the W-2 furnished to employees who terminate before the end of a calendar year and request a W-2 before the end of the year in writing. And the third exception, the W-2 provided by a third-party sick pay provider to employees of other employers. And there's a more extensive chart that I have on that link, and you can refer to that later. But these are the 3 big exceptions for that reporting on the W-2. Okay, for tax year 2012, partnerships are allowed to provide Schedule K-1 electronically to partners. The recipient must affirmatively consent, and the furnisher must provide a disclosure statement that details the arrangement between the partnership and the partner. Hopefully that will be a time saver, not mailing out all that paper and doing it electronically instead. The standard mileage rates for 2012, business driving, that gets 55.5 cents per mile. Medical and moving driving gets 23 cents per mile, and charitable driving gets 14 cents per mile. Not too many inflation adjustments, but we'll at least point out the status quo as well here for elective deferral plans, 401k and such. Just a slight tick up there. For the base amount, we rose from $16,500 to $17,000 for 2012. Catch-up contributions for those 50 and over stayed the same at $5,500, brings the total to $22,500 for 401k. Simple plans stayed identical, $11,500 base, $2,500 catch-up, brings the total to $14,000. No changes with the IRA deduction, $5,000 base, $1,000 catch-up, brings the total to $6,000. Slight bump up for the IRA phase-out ranges. Single and head of household increased by $2,000, so the range now is $58,000 to $68,000. Married filing joint and qualified widow also bumped up $2,000. The range is $92,000 to $112,000. Okay, looking forward, there's some pretty high impact Healthcare Act changes that affect 2013. So we'll go through some of those. The first one is increased tax for high-earning workers and self-employed. If you have some high-end clients, watch out. Some big taxes coming. Currently, wages are subject to a 2.9% Medicare payroll tax. Workers and employers each pay 1.45%. Self-employed people pay both halves, and it's levied on all wages without limitation. Under the new law, there's an additional 0.9%, so that brings the total to 2.35% of a hospital insurance tax that applies to wages that are received in excess of $250,000 for joint, $125,000 for separate, and $200,000 for other taxpayers. Employers collect the extra 0.9% surtax on wages exceeding $200,000, and the surtax also applies to self-employment income. Okay, next we have a counterpart. There's a surtax on unearned income of higher income individuals as well. Currently, Medicare payroll tax only applies to wages. Under the new law, the Medicare tax will also apply to investment income. It's imposed on individuals, estates, and trusts and the tax is a 3.8% rate of the lesser of net investment income or the excess of modified adjustable gross income over $250,000 for joint qualified widow, $125,000 for separate, and $200,000 for others. Net investment income includes interest, dividends, royalties, rents, passive activity gross income, and net gain from disposition of property, and reduced by net or investment deductions. There's been a lot of regulations and information that the IRS has put out most recently. Okay, we have a quick poll here. What percentage of your client base will be impacted by either of these two provisions? The surtaxes on Medicare, just to get a gauge on the audience here. Is it 0, 1 to 10%, 11 to 20%, or is it over 20%? Give you a second to fill that out, and then we'll go ahead and check out the results. Okay, 0 is 6.7%, and then it looks like the biggest category there is 48%. If you think your base is between 1 and 10% impacted, and then goes to 22% for the range between 11 and 20. And then if it's over 20, it's 23%. So pretty good distribution there. Thank you for filling that out. Okay, continuing on. There's a higher threshold for deducting medical expenses beginning next year. Currently, taxpayers can take an itemized deduction for unreimbursed medical expenses only to the extent that the expenses exceed 7.5% of the taxpayer's adjustable gross income. Under the new law, the government raises the floor from 7.5% of AGI to 10%. The AGI floor for individuals age 65 and older will remain unchanged at 7.5% through 2016, and then it bumps up to the 10%. Okay, they also have a dollar cap on contributions to health FSAs, or flexible spending arrangements, which are tax-advantaged accounts that can be set up through a cafeteria plan of an employer. Basically allows the employee to set aside a portion of earnings to pay for expenses as established in a cafeteria plan, such as medical, dental, or dependent care and other purposes. Currently, there's no limit on contributions to a health FSA. Under the new law, allowable contributions to health FSAs are capped at $2,500 per year and indexed for inflation after 2013. Okay, now we're moving into the section for tax reform, some of the ideas that are floating around. And last year we had in 2011, we had the Budget Control Act of 2011. This actually passed, so this is not tax reform looking forward, but there were some items in here that were forward-looking. Initially, there was a $1 trillion deficit reduction without raising revenue, and then the second $1.5 trillion deficit reduction needed to stem from recommendations from a joint select committee on deficit reduction. And they kicked around some fundamental tax changes, lowering their tax rates, cutting back on individual breaks such as mortgage interest, the post-2012 expiration of the Bush-era tax cuts, eliminating items such as accelerated depreciation, domestic production activities deduction, and LIFO inventory, and imposing a territorial tax regime. Well, the Joint Committee did fail to approve a report and we're faced with across-the-board reductions that must be implemented beginning in January, and that's 50% defense and 50% domestic. And that's actually part of the fiscal cliff talk. They're trying to adjust that so that the impact on the economy is not so great. So that conversation is wrapped up with the expiration of the tax cuts that we went over earlier. President Obama put forth a tax plan with tax reform, retaining the 10, 15, 25, and 28% rates, and then raising the top two rates to 36 and 39.6% for those earning over $250,000 for joint and $200,000 for single. Deductions and credits reduced the value of itemized deductions and other preferences to 28% for families with income over $250,000. Investment income retained the 15% rate for taxpayers with income under $250,000. Raised the rate to 20% for those making more than $250,000. So more impact there on high income earners. With respect to the alternative minimum tax, index the 2011 exemption amounts to inflation, and that would do away with the AMT patch that we see every other year. They also endorsed the Buffett rule. Households making more than $1 million would pay at least 30%. Lock in the estate tax exemption to $3.5 million, and lock in the rate at 45% for estates. Reduce corporate rates from 35 to 28%. Eliminate some industry-specific tax breaks, such as oil and gas. Overhaul the research credit, and renew some of the clean energy incentives. Also, some tax reform proposals to limit or eliminate deductions. The notion is to reduce some of the top rates and then broaden the base by taking away or reducing deductions and exclusions. Obama would limit the benefit of higher income taxpayers to 28% of the deduction or exclusion. The Fiscal Commission would replace itemized deductions with the standard deduction, or replace certain tax-favored deductions such as mortgage interest with non-refundable credits. Under Simpson-Bowles, they would eliminate nearly all tax expenditures and restructure certain tax expenditures, such as replacing mortgage interest deduction with the 15% refundable credit. Bipartisan Policy Center came up with eliminating itemized deductions and standard deduction, and replaced that with allowing taxpayers to claim a limited refundable credit for mortgage interest and charitable contributions. Under a widened codes plan, they would repeal certain itemized deductions and credits, bump up the standard deduction, $30,000 for joint, $15,000 for single, and retain mortgage interest and charitable contributions deductions. So we'll have to see how those play out into next year. I doubt they'll be able to handle those at the end of this year, but there's talk about some of these reform measures going into 2013. Quick polls question here. Does anyone think we'll see any tax reform next year? Trying to see how optimistic or pessimistic the audience is. Yes or no? We're going to get tax reform? Pretty optimistic. 72.4% say yes. The rest say no. We'll have to see if Congress can agree on anything next year. Okay, Internal Revenue Service initiatives that we're going to cover here. And a quick poll here. What is the composition of the audience? CPA, EA, the new RTRP designation, or attorney? And let's see the complexion of the audience. CPAs have it. 58.8%. EAs 15.3%. Ooh, RTRP, good number there, 24.2% for a new designation. And attorneys bringing up the rear, 1.8%. I guess you could have multiple, but I didn't account for that in the poll. So we will move forward. The IRS marks the third anniversary of Return Preparer Review. Mandatory registration and use of a PTIN. Anyone who is paid to prepare or help prepare all or substantially all of a federal tax return, including EAs. PTIN, valid for a calendar year, renewed annually. They have almost 850,000 preparers who registered. Big number there. Under Return Preparer Review, they have the competency test, available at more than 260 vendor testing centers. Certain preparers are required to take the test by 12/31/2013. So coming up on that deadline. The IRS urges an estimated 340,000 preparers are required to take the test. So still quite a bit outstanding. CPAs, EAs, and attorneys are exempt. Certain non-signing preparers supervised by CPAs, EAs, or attorneys are exempt, as are non-1040 preparers. You can go out to irs.gov/PTIN to determine if there's a test requirement, set a test date, time, and location. And there's also more information at this other link as well. Continuing education, the roughly 340,000 preparers who have a testing requirement also must complete the 15 hours of CE each year. 10 hours attributable to federal tax law, 3 hours in federal tax law changes, and 2 hours for ethics. Effective January 2012 applies even if the preparer has not taken the test yet. Hundreds of outlets offering IRS-approved CE courses, irs.gov/taxpros/CE. Ethical requirements that have previously applied only to CPAs, EAs, and attorneys now apply to all paid return preparers. All paid preparers also will undergo a tax compliance check and are subject to standards for practice outlined in Treasury Department Circular 230. The new designation, RTRP Registered Tax Return Preparer. Preparers who pass the competency test and tax compliance check. To date, over 4,800 people have become RTRPs, so still quite a bit outstanding. They have until the end of the year or the end of 2013 to pass the test. Beginning in 2014, only RTRPs, EAs, CPAs, and attorneys will be authorized to prepare individual income tax returns for compensation. The IRS has created a publicly searchable database. It allows taxpayers to see if preparers have met IRS standards or to find a preparer in their zip code area. Show credentials held by each preparer. Public education campaign to inform taxpayers to use only CPAs, EAs, attorneys, and RTRPs if they pay to have their taxes prepared. Intuit and the National Association of Tax Professionals both team up for professional development. It's at natptax.com/Intuit. We offer more than 300 live nationwide workshops, facilitated online, self-study, and webinar courses designed by tax professionals. You can maintain your CPA, EA, RTRP status with CPE courses, and also some preparation courses for the EA and RTRP examinations. Okay, before we get into the identity theft area, how many of your clients have been victims of tax-related identity theft? 0, 1 through 5, 6 through 10, or over 10? It's a huge issue with the government, so I'm just curious how many people are impacted. How many clients have been victims of tax-related identity theft? Okay, we'll turn it over. Okay, 0 is 48.1%, 1 through 5 clients, 45.9%, 6 through 10, 4%, and then over 10, 2%. So looks like over half have been impacted in some way. Interesting. Thanks for answering that. Tax-related identity theft. IRS distributed about 250,000 identity protection personal identification numbers, IP pins, in the 2012 filing season. Expanded pilot program to protect victims of previously filed confirmed cases of identity theft. So it's only aimed at repeat offenders. IRS estimated that it stopped at least $1.4 billion in refund fraud in 2011. IRS has identified more than 460,000 taxpayers victimized since 2008. With respect to the IP PIN program, the IRS mails out a unique 6-digit identifier for use in the current season only. Taxpayer who believes he or she was victimized would fill out a Form 14039 Identity Theft Affidavit. The IRS verifies the information, then flags any return filed under the taxpayer's taxpayer identification number to make sure it's not filed fraudulently. Taxpayer then uses the IP PIN on the tax return. And the crime surge that the IRS has seen is due to an increase in the refundable tax credit area. This program, the IP PIN, is not widely publicized, so identity thieves don't adapt to their strategies. Unfortunately, the system's not infallible. Difficult to issue quick refunds and also check for fraud. That's the balance that the IRS is trying to figure out each year. They don't want to bog down refunds, but at the same time, they need to check for fraud. IRS never initiates contact by email or social media to request personal or financial information. The post office that delivers IRS notices is not secure. Taxpayer must keep this IP PIN private and secure to make it successful. And again, this program is only designed to prevent repeat offenses. The IRS has recently revised return preparer penalties. I'm going to go through some of the higher impact ones. $50 for each failure to furnish the taxpayer a completed copy of a tax return, up to $25,000 per preparer per year. $50 for failure to sign a return, up to $25,000 per preparer per year. $50 for failure to furnish a PTIN per return, up to $25,000 per preparer per year. $50 per failure to retain a copy or a list, up to $25,000 for any return period. $50 per failure to file an information return or include an item thereon, up to $25,000 for any return period. $500 per instance of a preparer endorsing a refund check issued to a taxpayer. And then finally, $500 for failure to comply with EIC due diligence requirements. Hopefully you won't run into any of those penalties there. Some greater due diligence requirements for earned income credit claims, and you'll see them imposed on the Form 8867, the Paid Preparer's Earned Income Credit Checklist. You must meet due diligence requirements in determining the taxpayer's eligibility and credit amount. You need documentation for residency of a qualifying child, such as school records. You also need documentation for a disability of a qualifying child, such as a doctor's statement. And you have to support the existence of a Schedule C, such as a 1099. Retain all supporting documents, such as checklists, worksheets, etc., for 3 years. And as we saw previously, the penalty is $500 for each infraction. Really clamping down on the EIC violations. Modernized e-file, MEF, represents the next generation, replacing the older legacy system. It's built on an internet-based platform. Transaction-based system allows originators to transmit in real time instead of batches. Faster processing time. Refunds eventually will be issued in several days. Improved error detection and more detailed rejection messages. Expedited acknowledgments sent within minutes instead of 48 hours. It allows you to attach PDF files. Standardized business rules apply. This is the final year of the phase-in period for individual. So this year, all individual returns will be filed under MEF. Previously, we had only a portion. However, all the business returns were filed under MEF previously. Doesn't change the way you transmit your tax returns, and it's fully supported by Intuit products. IRS continuing to embrace social media. There's an IRS To Go smartphone application for the iPhone, the iTouch, and the Android, where you can get refund status and tax updates. Short, informative YouTube videos on various tax-related topics. They're in English, American Sign Language, and a variety of foreign languages as well. Twitter feed at IRS News. You can get tax-related announcements, news for tax professionals, and updates for job seekers. Audio files for podcasts, useful information on one tax-related topic per podcast, available on iTunes or through Multimedia Center on irs.gov. The IRS is also helping college-bound students with the financial aid application process. IRS Data Retrieval Tool allows applicants to transfer tax return data to the free application for Federal Student Aid Form, FAFSA. The tool is free, easy, and secure, saves time, and improves accuracy. You need a Federal Student Aid PIN. You can apply for one within that process. If you can't use this data retrieval tool, you may need to obtain official transcript from the IRS to order one. Go to irs.gov and select Order a Transcript, or you can call the toll-free number that we have listed here. IRS also offers money-saving information for college students and their parents about tax credits, deductions for qualifying tuition, materials, and fees. And we have a link to access that information here